So good afternoon and welcome everyone to the Sage Investor webinar. I am Jen and I'm a co-founder of the Sage Investing Group along with Maggie and Lana. We're really excited to have you guys join us today for our webinar on how a Sage investor can vet a deal in 10 minutes or less. So just a little context, today's webinar was actually inspired by one of our investors. So early in his multifamily investing endeavor, he asked us, well, how do I know if I have a great deal in front of me? What should I really be looking for in these investor decks? What kind of numbers should I really be focusing on to let me know whether this is a good deal or not? So we imagined that if he has these type of questions, many of our other investors would probably be wondering the same thing. So then we came up with this checklist so that at a glance, you can go through any investor deck and make a determination of whether or not it is a deal that you might want to spend more time looking at. So keep in mind that, when you're looking at a deal, it's not just a deal that is important. It is also very important to consider the operator and the market. So Maggie will be talking about these two critical factors in her part of the presentation today. Now, before we get started, I just want to do a little quick introduction about the three of us. Just to let you guys know, all three of us, we actually came from the Big Four accounting firms. So our background is rooted in audit and risk management. And some people may not know what audit means, or if they are familiar with it, they want to run the other way when they hear that word. But we promise that we are actually on your side. We position ourselves on your side in the situation because we are using our combined 35 years of professional experience working in audit, accounting, finance, along with our real estate investing experience and our multifamily underwriting experience to do what we do now in multifamily syndications. So the deals that we present to you as the investors are vetted by the three of us so that busy professionals like you guys can invest with greater confidence in these syndications. So having said that, and being that our webinar today is about vetting the deals yourself, I just want to put it out there that yes, we do vet the deals before we share them with you, but we feel like it is equally important for the investors to vet the deals themselves, to have a full understanding of the deal and to challenge us with any questions that they may come up with. Because obviously we share with you guys the deals that we think are really great, but if you guys see something that you want to ask us questions on, that's great. We welcome all of that. So today, our group actually has now over 180 Sage Investor members, and we also have 450 followers on Facebook. Collectively, we have done over 14 deals together and over 3,000 units, valuing at over $350 million. So evidently, based on that portfolio, we obviously believe that multifamily is one of the best asset classes out there to invest in. So we created this webinar series to essentially provide you educational content so that you guys can learn along with us and decide for yourself if this investment strategy is also right for you. So this webinar is really great for you if you have tried to invest in syndications before, but ended up backing out, or maybe you've invested in syndications, but didn't really feel like you know enough, or maybe you just haven't really even started because you just feel overwhelmed by all the information that's out there. And just a little disclaimer before we get started, this is for your education only. Although all three of us have a CPA background, Sage is not a legal, financial, or tax advisory firm. So we ask that you please consult with those respective professionals if you guys have those type of questions. And also please know that we can't guarantee any returns. As you all know, there are risks associated with any investments. So throughout the webinar today, after we're done, you should be able to walk away with answers to the following three questions. such as why effective and efficient screening of deals is vital to your success as a passive investor, how to complete your initial due diligence on a deal in 10 minutes or less, and then number 3, what makes a deal worth your time to perform further due diligence on. With that, I'm going to pass it off to Maggie.
Thanks, Jen. Okay, before we get right into it, let's talk about why effective and efficient screening a deal is vital to a success of a passive investor. As a business professional, you don't really have the time, all the time in the world to vet through every single deal. So you have to start with somewhere and really understand your goals and your investment philosophy. And if you're like us, we believe in these 4 tenets of conservative investing. These are our investment philosophy here at Sage. So number 1, we invest primarily for capital preservation. And taking a page from Mr. Warren Buffett himself, his rule number 1 is never to lose money. And his rule number 2 is never forget to rule number 1. And number 2, second, we invest for cash flow. Cash flow is king. It doesn't matter what asset class you're in and what market cycle you're in. As long as you have cash flow, you're going to ride out any storm. And third, we look for assets that are going to appreciate. And we're not just talking about natural market appreciation, because that's not something you can really control. I'm talking about forced appreciation. So for larger multifamily, it acts more like a business. So the valuation is derived from how much income it can generate. This gives us a lot more control on the opportunities to increase the net operating income through increasing rents, decreasing expenses, and adding more additional stream of incomes, which directly increases the valuation of the property. All right. And number 4, it's no secret that the tax code was written in favor for real estate investors and also business owners. So if you want to learn more about this point, you can actually watch our tax webinar from the previous week. So with that said, now, so to support our 4 tenets of conservative investing, there are 3 facets to consider when it comes to investing in multifamily. And these are the operator, the market, and the deal. And as a LP investor, limited partner investor, you will not have any day-to-day responsibility, but so you're entrusting a lot to the operators. So you want to make sure you can trust the operator and you're dealing with honest and competent team. As an example, you want to see if they have a track record and experience to carry out a business plan. If there's an operator who is experienced in light value add assets and they're suddenly looking to invest in ground up development, that might not make sense unless they brought in someone who have ground up development experience in the partnership team. You also want to know if the operator is using conservative assumptions when they are underwriting that are based on actual facts and also rooted in very fundamentals. For us at Sage, when we partner with other operators, we do additional measure and conduct a background check and also reference check on behalf of investors. For market, something we like to see is a few examples that we like to see is 1, a stable and growing population, 2, landlord-friendly state, especially a time like this, and 3, a diverse and growing employment base. As an example, you don't want to see there is one employer or industry that is employing more than 25% of the population, which can pose a concentration risk. Now, in terms of the third thing is the deal. We can actually go hours and hours on this topic because it's right up our alley. But today we're specifically focusing on helping you learn how to quickly evaluate a deal to see if it may be something you want to invest in. So without further ado, I'm going to turn it over to Jen, and she can walk you through how to vet a deal with a handy dandy checklist. Jen?
Thank you so much, Maggie. So when the next time a deal lands in your inbox, you can whip out this handy dandy checklist that we're going to share with you. And this list was created specifically for multifamily deals. And you can use it to quickly see if a deal passes the initial smell test. What I'm going to do is I'm going to go through this list and explain what each of these means and why they're important to you. And then following the checklist, we're going to go through a sample deal to show you where you can find these type of information on the investor deck. Most deck would contain a majority of the information that's on our checklist, but if they're not on that deck, then you can easily reach out to the sponsors to get the answers to your questions. So with that, let's get started. The first question on this checklist that you want to look for in the deal is, what is the asset class? As you know, when you invest in multifamily, there are actually 4 asset classes, and the rating for these asset classes are similar to how you get graded in school. So A are obviously the cream of the crop students, and likewise for apartments. These are essentially luxury class apartments in the best neighborhoods in town. In this asset class, since you're already at the top and you're a top performer, there isn't really a lot more room for growth. And then B class, if you're a B student, you know, that's still something to be really proud of. B class properties are still very nice, and they are in good neighborhoods. They're typically built in the 1990s or later. And as you know, if you are a B class student, you know that with some additional effort and time, you could probably bring your grade up to an A. So then likewise in multifamily investing, if you are to infuse some additional capital and some additional TLC into a B class property, you could potentially bring that property up to maybe a B plus or an A minus property. And then the C class properties, as you know, C is kind of average. So in apartments, this is like properties that are built in the 1960s or later, depending on the condition. So usually C class properties, we're going to find kitchen and bathrooms that are a bit outdated. There might have been some renovations here and there, but they're not going to be in the best, they're not going to be really updated too much. And so it's similar to like a B. If you infuse capital into a property that's a C class and do things such as like adding amenities to it, making key exterior and interior upgrades to the property, a C class property could potentially move up in grade a bit to maybe B plus. And then D class property, well, as you know, your parents will probably be pretty angry with you when you get D's in class. And so D class and apartments essentially are properties in really rough neighborhoods. And these are properties that you probably don't want to go to alone. And there's tons of different maintenance. And for us, we just feel like these properties just have too much work involved and way too much risk to really bring our investors into these type of investments. So we stay away from D class. So at Sage, we just love B and C class really because of the value add opportunity that are present in these apartments. It gives us the most potential for generating returns for our investors, and it also allows us to make the biggest community impact. Next is the units. So one of the reasons why we invest in multifamily is for the economy of scale. We have found that properties that have 100 units or more are best at giving us that economy of scale. So it allows us to essentially generate enough revenue to warrant having a leasing office on the property so that we have personnel on staff on the property to keep an eye on it. And so for us, we really like anything more than 100 units. Now, what is the equity multiple on the deal that you're looking at? The equity multiple is defined as the total cash distribution received from an investment divided by the equity invested. So just for context, anything that's less than one times equity multiple means that you're getting back less than what you initially invested, and that's not good. So we minimally like to target for 2 times equity multiple because we want to double our investors' money by the end of the hold period. And what is the internal rate of return? This is a return figure that takes into consideration the timing of when you'd get your money back. You want this number obviously to be as high as possible because then that means you're getting your money back sooner. And so it's really a good figure for you to use when you compare different deals across the board. It's similar deals across the board to see which one might have the highest IRR. We typically think that anything with a 15% IRR is really good. Another question to ask on the property that you're looking at is how long is the interest rate fixed for? So this question is for assets that are being purchased with a conventional loan. And typically, we think that any period that is longer than the whole period is ideal. And nowadays, with the cap rate being a bit lower, some business plans have to extend the whole period to 7 years in order to generate the type of returns that investors are looking for. So we think that a fixed rate loan of 10 years or more is ideal because it would cover more than the greatest time frame that we would need to carry out the business plan at 7 years. Now, how many years is a loan interest only? That's IO for interest only. For both conventional and bridge loans, the lender will typically include a few years of interest only payments. And the highest we've seen this is at 3 years. So we think 2 to 3 years of interest only would make the deal pretty strong. Obviously, interest only means that we have, in the first few years, it's great because it gives the property more capital to work with, right? We don't have to spend as much money paying down the principal on the loan. Now, what is the reversion cap rate? The reversion cap rate is also known as the exit cap rate, and it measures what the anticipated cap rate will be at the end of the business plan. So rule of thumb is that you want to see the exit plan being higher than the entry cap rate. And we like to typically see escalations of 0.1% or 10 basis point for each year of hold. Number 8, when you look through the deal, you want to see how does the rent compare to other similar properties in the market. So usually in the investor deck, the operator will include some sort of chart or graph that compares where the property stands in relation to how much the other properties are being rented out for. And so you definitely don't want to be the leader of the pack in this category, because then you're going to be charging the highest rent in the market and there wouldn't be any room for pushing that rent up higher. Number 9 is what is the projected rent growth? So in our current environment, we think that underwriting below 3% rent growth is ideal. So really you want to see on the investor deck that they're projecting maybe 0 to 2% at most. I don't know if some of you guys might know, but there are actually cities out there that are experiencing rent growth despite going through this whole pandemic. So just understand that even though a deal is underwriting conservatively and showing 0 to 2% rent growth, know that if the opportunity is there, the operator will for sure try to capture this rent premium in the market. Now, what is the projected vacancy? So this is also important to look at because projected vacancy, it is the anticipated loss in rent for any vacant units plus loss of rent for other reasons such as tenants not paying the rent, or maybe a model unit or a staff unit that is not generating any rental income. In today's environment, with the eviction moratorium in place through the end of March and maybe getting extended, it is ideal to underwrite with a physical occupancy of 2 to 3 times the market occupancy vacancy rate. So let's say the market has a 5% vacancy rate, you would generally want to see the operator underwriting at 10 through 15%, 10 to 15% for that particular property to be conservative. So generally, if you don't really know what the market vacancy rate is, you can just kind of use 10% minimum project vacancy rate as a standard for measuring whether the deal is underwriting conservatively or not. Now, what is the debt coverage ratio? So the DSCR is a ratio of the cash that's available for servicing debt such as interest and principal on the loan. So obviously, the higher this ratio is, the better the property is positioned to pay the mortgage. Lenders like to see at least 1.25. Finally, what is the break-even occupancy rate for this property? This figure tells us at what percentage the property has to be occupied at in order to bring in enough rental revenue to cover all of the property's expenses, including the debt service. we like to see a break even of 65% or lower. So this is the complete list with the 12 critical points that we just went through. And we're going to share this list with you, so don't worry. We'll share this list with you along with the webinar recording once we're done. And so just want to let you guys know that this list, it is based on ideal criteria that we look for in Class B and Class C assets. So of course, if you want to invest in Class A properties, you would want to shift some of these criteria around a bit to fit what you're looking for. So using this just checklist as a guide, I'm going to now walk you through an example investor deck for a deal that we actually just closed on in December. The sample deal that we're going to look at today is called Oak Brook Apartments, which is located in Fort Smith, Arkansas. This was our third acquisition in Fort Smith in 2020, and I'm really happy to report that it is doing quite well. Oops, sorry, I think I just clicked on something. Sorry about that. I thought I removed the link, but anyways, it took me to the investor deck. So anyways, so I went through the investor deck, and just for sake of time, I extracted a few key pages from the deck to show you guys where we can find information that we are looking for to fill out our checklist. So in this investment summary, we can see here on this side the number of units and the year of construction. Great, there's more than 100 units, so there's 134 at this particular property. So that's really good. And as you can see here, sometimes the investor deck won't tell you exactly which asset class it is. It will just tell you the year of construction. So with some experience, you would be easily able to tell by the year that it was built, whether it's a Class B or Class C type property. Since this one is built in 1977, and we know that's a Class C, that's what this one is. So if you're not sure, the best thing to do is just to ask the sponsor. And in terms of the returns, you can see here that cash on cash is projected at 11%. Our guideline is anything 10% and above is really great. The IRR is 17.3, and we think anything 15% or above is really great. And the equity multiple is slightly above 2x equity multiple. Next, if you look at the market overview, you'll see this graph that shows how the investment property stacks up against the other rental comps in the area. So in this instance, we see Oak Brook here as being actually the cheapest apartment in town. And as I mentioned, you don't really want to be at either extreme of this graph, but I'll explain that in this situation, we were fine with it because during our physical due diligence of the property, we didn't really discover anything about the Oak Brook Apartments that would warrant it to be, charging the lowest rent in town. In fact, the prior owner, the seller, they just didn't infuse any capital into the apartment complex to warrant increasing the rent. So it was fine by us because it only gives us more opportunity to bring in that fresh new capital and to renovate the property so that we have plenty of room to push our rent closer to our competitors. And now in the financial analysis deck, we are able to pick up a few other key metrics about this opportunity. You can see here the entry cap rate is at 7% and the exit is at 7.4. So based on a 6-year hold, you can kind of divide it and see the average increase per year is 0.7% per year. So we mentioned earlier that we like to see a 10 basis point increase, which is ideal. So being this deal is slightly lower, we would have to mark this category as good versus ideal on that checklist. And then as you may notice here, they also have what we call a sensitivity analysis. And this chart tells us the range of returns that you can expect if the cap rate should go up or down at the end of sale. So here's 7.4. If it goes up to 6.75, the expected return could go all the way up to 19%. So in the cap rate, the lower it is, the higher the valuation for the property, the higher the cap rate, the lower the valuation. So therefore, the lower the return. So anyways, a general rule of thumb is that you want to make sure that the exit cap rate should always be higher than where you started, to be conservative. So as an investor, you just want to ask yourself, would I be okay with the returns being lower if the market takes a downturn? So we think the chance of that happening is pretty unlikely, because in the multifamily space, the cap rates are kind of compressing by the day. The data is showing us that there's actually an undersupply of affordable housing in this country. And so if demand remains high, we just don't really foresee multifamily property valuation decreasing anytime soon. And then going back to here, it tells us also the year one break even occupancy. If you recall, I said 65% is what we look for, and here is at 58.3. And then here it even tells us the fully occupied break-even rent, which is about $300. So this is saying that if the property is 100% occupied, then at what average rent does a tenant have to pay in order to fully pay for all the property's operating expenses plus the debt service? And then finally, the DSCR here is 2.61. Earlier, I mentioned that the lenders really like to see anything greater than 1.25. So you can see throughout the life of this investment, the DSCR is well above 2, and that's really good. So now at this point, you can see that we have filled out a majority of this checklist based on the investor deck. And there are 4 categories that we couldn't find any information on. So for any categories that you can't find information on, just email the sponsor, and you can usually get the answers to those. But just to give you a complete picture for this deal, so we can go ahead and finish up this checklist, just want to let you know that Oak Brook was actually financed with a 10-year, conventional loan with 1 year interest only, and with a fixed interest rate at 3.51%. And then in terms of the projected rent growth, it was consistently at a conservative 2% per year. And then given that it was coming out with the lowest rent in town, and we're infusing capital into the property, a 2% rent growth is fine, it's conservative. And we're about like 2.5 months into this ownership of this apartment right now. And we can tell you that even without any renovations, we've been able to get rent bumps on renewals. So the projected vacancy here, for the pro forma for this particular investment, it was ranging from 11 to 15% throughout the life of the hold. And this is information that we have. It was not on the investor deck, but per the Department of Numbers, Fort Smith vacancy rate was like 4.73% in 2019. So with a range between 11 to 15, we are under the ideal category. So with that information, we can go ahead and check the remaining boxes, and here we are with our completed list. If this looks like a deal that you want to, maybe look more into and do more diligence on and potentially invest in, can I get some participation and have you guys type yes or no in the chat box, just for fun? And just to see if you guys are paying attention. Thanks, guys. All right, great. Thank you, guys. So obviously, the more ideal boxes that are checked, the more that we love the deal at first glance. I don't want to say that there is a precise measure of like the number of ideal versus good characteristics in order to move forward with the deal, since everybody has like different investment goals and different risk tolerance. However, I think if you start seeing this chart is getting more middle and right heavy, then I would probably put my pencil down and really not pursue it much further than that. So as a quick recap, just know that before you invest in any deal, you need to make sure you know the operator, the market. And once you know those, you can use our handy dandy checklist to quickly vet the deal to see if you want to do more due diligence on it. And don't get discouraged. It seems like a lot of work to vet a deal, but we think just like any new endeavor, vetting deals do get easier with time. You know, the more deals that you look at, the more exposure you have to these deals. Because once you know a few operators that you like to work with in a few markets that you want to be in, it's really quite easy to just focus on vetting the deals themselves. Now, you may be wondering, would most of the deals that we send to you guys have been vetted, and therefore it would probably pass this checklist test? Yes, yes, that would be the case. We do go through each of these deals, initially looking for these key metrics as well. But we also think it is very important for our investors to do their part and to conduct their own due diligence. We want you guys to ask us questions. We want you guys to challenge us on why we think this deal is so great before you invest your hard-earned money into anything that we share with you guys. So this checklist is really great, and it can be used across all deals, even those that are not shared by us. And it's just a really quick way for you to decide whether or not you want to spend more time doing due diligence. Because once you decide that you do want to move forward, you would have, you probably want to listen to the webinar, which is usually about an hour long. And then you probably want to spend some more time calling the investors, calling the sponsors to ask them some additional follow-up questions. What I do want to share is that, the value that we bring to our investors is that we look beyond these metrics. That's why I mentioned, we use it, and, we may love the deal at first glance, but we want to dig deeper into these deals after we go through this checklist. So how we do it is that we stress test our deals to assess whether or not they would continue to perform, whether they would continue to have acceptable performance for our investors under certain stressful scenarios. So using our thousands of hours of underwriting experience, we stress test the deals by increasing things like the interest rate, the CapEx budget, in case of overages, which happens. And then we increase the economic vacancy on the property, we decrease income, we extend the renovation period. So all these different ways of just stress testing the deal to make sure that it will still perform. So as you know, no one really has a crystal ball. So we really have to rely on our available resources, right? Such as our experience, our analytical skills, our market knowledge, and any available data out there that would help us make the best possible investment decision for ourselves and our investors. So that's why it is so important for all of us to do our part and do our due diligence. And this checklist is a great way to start. So with that, we are open to questions. And oh yeah, if you have any questions, you can go ahead and type them into the chat box, or I'm open to you just turning on your mic and asking us directly as well. That's fine. And while I wait for these questions to come in, if you guys are typing in the chat box, I just want to say that if you guys found the webinar to be helpful, and you might know somebody, maybe a friend or a family who might be interested in learning more about multifamily syndications and diversifying their portfolio, then please, we appreciate it if you would please refer them to us, or maybe you can invite them to a future webinar so they can learn as well. So if you're not part of our investor circle already, or if you have a friend or family that wants to join, you can refer them to our website, sageinvestinggroup.com, and you can simply fill out the questionnaire that we have on there, and then set up a call with us so that we can get to know you guys better and see if what we have to offer fits your investing strategy. So with that, that's all we have for you guys today. And I think if any questions, I'm going to throw it out one more time. Any other questions from anyone?
I have a quick question.
Yes.
I was wondering when.
Wait, who is this?
Oh, this is Jason. How you doing?
Oh, Jason. Hi.
Can you see me? Hi. Yeah, I was wondering when after the acquisition of the property and before starting renovations, how does it work to kind of create vacancy so that you can get the crews in there to, work at scale? Like, just wondering, how is that managed?
So sorry, Jason. So you're saying before acquisition, how do we create vacancy, the necessary vacancy that we need in order for our crew to come in and start renovating the property?
Yeah, that's right. Does it happen all at once? Or like I noticed in this case study, there were multiple buildings. Do you do like a rolling process from building to building, or, how does that work exactly?
Yeah, that's a really great question. Maggie or Rana, would you like to take that?
Sure. Hi, Jason. So that's a good question. So what we would typically do is even before we take over day one, we have a really in-depth conversation with our property managers and the crew and the local expertise in the area. And we have like a plan out, figuring out like how can we phase in this renovation plan. And for example, the Oprah property, it is a pretty high occupancy rate. I think it's like a mid to high 90. So you really do not want to get rid of all tenants. You're going to disturb the cash flow. So what you want to do is phase it out over I think we did it over 12 to 24 months periods. So I'm phasing it out. So thinking about like who are we wanting? Well, first we're going to address, okay, when we renovate, when we ask for renewal, we're going to renew with rent bumps and test out, okay, at the renewal rate, are people taking in those renewals, and how likely and acceptable are those renewal rates? If those are taken, maybe we don't need to put in as much cash into renovation plan. And if otherwise, we'll also, because these are all performance based, right? So that when we actually get on site, we test it out at each a specific apartment. So, and then we also test out if there's a renovation plan. We put in maybe something more simple renovation plan versus a little more higher end, and see how that taken into the account to the specific market. So for Oprah, for example, right now we are renovating a few property at a time, and it's been really accepting. So it is on plan based on what we have planned out. And for any renovations that I will say, like for occupancy rate that is a little lower, then you can go in a little bit a more aggressive plan. But we typically do not want to do that because we want to take over day one at day one of a property with a cash flowing perspective. So then it'll be still cash flowing, and then we try not to do it too quickly. And we will take a little over time because we want to make sure that our tenant base is also accepting the new ownership as well. So we phase it in, let them know that we're taking care of the property first. We wanted to increase the community, fix it up, add amenities, so they can really see the value that we're putting in before we actually increase and be more aggressive. So we want our tenants to like us because they're paying the bills at the end of the day. So.
And just to kind of add to that, even before we acquire the property, there is a due diligence period. And as part of that due diligence period, one of the things we look at is the lease, like a lease audit. So what we're looking to understand is, do the tenants that we have at the property good tenants? They have a strong income. They're able to demonstrate they can continue to pay their rent. And then we want to keep those tenants. And then if there are tenants, to your point, how do we think about doing those renovations if they're occupied? Well, there may be some tenants that just don't fit our business plan profile. They haven't been paying their tenant rents, or they're delinquent in paying their tenant rents. And so we might actually roll out, and this is obviously a conversation with the property manager, like you mentioned, but we can actually do something called a cash for keys program. This is where we incentivize the tenant saying, hey, are you able to come up and make whole your rent that's late or due if there's a large balance, or can we work on a program? If not, would you be open to maybe breaking your lease contract, but we'll give you cash so that you can move out, and whatever loan whatever debt have outstanding, we'll clear it out. We'll just start fresh even with you. And then for us, yes, it is a cost up front, but in the long run, it saves us two things. First is we don't have to worry about the headache of having a tenant that's not paying their rent, but they're sitting there occupying our unit that we can renovate and rent out. And then with that said, it is an upfront cost, but kind of going back onto that, if we pay that small upfront cost to them, paying a small portion to incentivize them to move out, we can then use that as a vacant unit to renovate quickly and further our plan. So the quicker we can turn those units around, the quicker we can fill them up with higher paying tenants, better for our cash flow too. So it is a little bit of balance of wanting to maintain the cash flow upon acquisition, but also looking at the quality of tenants we have to say, okay, who do we want to do a clean out on, and how do we want to roll out a program that's best for everybody? And so it's a balancing act. I don't know if it helped answer your question, but
yeah, it does, and I certainly appreciate the sort of human-centric or humane approach that you're all taking. So that's definitely nice to hear. And I hear the sort of, there's this like tension or this like sort of like middle point in this sort of like graph of like keeping tenants in versus bringing in renovation crews. And I wonder, how do you manage finding that sweet spot for like minimum number of units to renovate at once to get that sort of efficiency of scale, in the, like, how do you calculate that to figure out like, oh, we only have 5 open and that's not enough to get a crew in, so we're gonna let them sit, versus, okay, we've got 20, we're ready to go with, some movement.
Right. It's a really great point. And as part of that calculation, sometimes we don't have to be as aggressive, because as part of our lease audit, we'll see contracts that are almost coming up due. So they're expiring anyway. So we can, always offer to renew them. But it's not really breaking any contract, because, we'll really like to focus on bringing the community level aesthetics up, like focusing on the curb appeal, putting in nice amenities so that they can see, oh, these owners are really caring about the property, and they can visually associate, okay, these guys are asking for more rent, but it makes sense because they're trying to beautify this community, bring in more value, bring in more, neighborhood friendly neighbors or renters, right? So if they start to visually see that, it starts to bring the element of maybe it's worth it to pay a little bit more, or even if in certain cases, if they live in a non-renovated unit, but they want to stay in the property, and maybe the leasing office is offering, hey, there's a vacant unit we just finished. If you pay a little bit more, you can move in there. And it's just moving them from one renovated unit to a renovated unit. So it's a lot of it is a conversation with the tenants, because it's a partnership, right, with them too.
Yeah, I just want to add, like, I guess to your point, Jason, it's for Oakbrook, we do utilize our property managers who is very local on the ground, and because this property is highly occupied, we do have another vendor who does go in day one and renovate a lot of units up front, but that requires maybe 20 or 10 or 20. That makes sense for them to come in to do a built out renovation plan, a full renovation plan, and implement it right away. But for Oakbrook, we feel like we don't really need to do that in this case, because there's very high occupancy. We can roll out in our underwriting assumptions, we put out like 18 to 24 plan to kind of, once lease is renewed, then we roll it out to rent bumps, and then we also do the renovation plan over time, because there's really, you don't want to get rid of all those the good paying tenants anyways, because Oakbrook is actually one of the highest paying 100% collection most recently. So we wanted to keep that.
Yeah, that's awesome. Thank you for sharing that and for all that insight. That's interesting about the curb appeal piece, about like, beautifying the outside and not requiring, any bump or any, occupancy to do those things. That's interesting insight. I hadn't thought of that. It makes me think about something I shared with you, Jin, in our intro call, of like, one of my passions is electrification. And I've been geeking out about that pretty hardcore for the last year here, because what else am I going to do with my free time while I'm locked at home? Fiddling at home, but not on a scale of 100, of course. It's like I have 2 units here sitting at my house. But the electrification work is something like that as well, of like these energy upgrades are perhaps something like that, where you don't have to have vacancy to do a lot of these things, but there is this opportunity for, in the long term, lowering OpEx of the the building of your multifamily. So I wonder if there's opportunities like that. And a lot of those are structured on 10-year sort of loans. A lot of these upgrades like solar and batteries and stuff like that, HVAC systems, heat pump systems, that kind of thing. So wondering if that kind of fits into your model as well, as you think about these sort of beautification pieces.
Absolutely. But that's one of the decisions that we think about is whether, because sometimes when we look at the deal, when we talk to our lender, mortgage broker, she does mention like for certain loan types, we might be able to get green rewards. So we can get extra reduction in our interest rate in order to execute that. So if there is a balance, we do consult like a consultant to actually walk the property to see what kind of energy saving and water conservation that we can do in order to qualify for that green program. So, and see how much it will cost. So we have to factor that into our budget and as well as our assumption. So.
Right. I mean, we would factor that in anyway to your point, if it helps further reduce our OpEx, that helps our bottom line NOI too. If we can also get the green reward points, even better, because that helps our rates. And so again, further helps our cash flow. So we look to optimize our business plan as much as possible. And, putting in like LED lighting, especially for like parking lights, having bright and, brightly lit common areas brings a little bit of a homey feel to properties. And it doesn't do, especially if you're going to do that, yeah, electricity bills may go up, but the LED light certainly helps and goes a long way for that. And lenders like it. So they even may throw us, that bone.
That's great. That's great to hear. Yeah, the rebates are challenging right now. I wonder I know this is a follow-on question, I'm sorry. I wonder a lot of the rebates are interesting. I've been tracking them and they're of course evolving with the new administration, but I wonder, how do you factor in something that is so uncertain into the business plan? Is it like, oh, bonus, and there's like, extra 5% savings, or is it just like, oh no, this didn't work out, what do we do now? Like, how do you factor these things in, in this weird time?
But sorry, before you guys answer that question, I'm so sorry. I just want to, be considerate of other people's time. So if you guys have to go, definitely no worry about it. Thank you so much for attending. But if you guys want to hang out and just chat and, hear these answers to these wonderful questions, you're welcome to stay as well. Sorry, Lana, go ahead.
I was gonna say, Jason, that's a really good question. And I would say definitely ask that as one of your questions to the operator. How have they considered all these extra bonuses of cost savings? For our purposes, we like to err on the conservative side. So on things that we are less certain about, but we know that we have these options to play upon after acquisition, we don't account for it in our underwriting. These will be bonuses that we can hope to maybe achieve after acquisition, but for now we're going to underwrite it as assuming we won't be seeing those savings.
Thank you. That's great. Appreciate it.
Yeah.
Well, thank you.
Any other questions?
Nobody else has any other questions. We really appreciate you guys attending today, and we definitely hope to see you guys at our future webinars. And we love to have more people join us. So spread the word and invite your friends to join as well. But thank you so much, everyone. And you'll get a copy of this recording later on today. All right, take care.
Thank you.
Thank you.
Bye, guys. Thank you.